um, audit evidence is all the information that you as the auditor is going to use so that you base your conclusion, or in simple terms, so that you arrive at the right conclusion. Remember, as an auditor, we are going to assume you are an engagement partner at this level, or you are an audit manager. So as an audit manager or engagement partner, you're at a level where you can conclude on the audit report. Now, for you to conclude on the audit report, it means you have to gather information. So this information which you gather, it will help you to make the right decision on whether the financial statements are true and fair. Now, we are going to get evidence in connection with the assertions that the auditor is going to use. So we'll be looking at assertions shortly, but what is most important here is evidence. Now, audit evidence, we are going to look at two sources of information. The first information will be that information which we have in our accounting records, which are going to underlie the financial statements. So we might have a lot of information in accounting records, such as sales invoices, receipts, vouchers, remittance advances, debit notes, credit notes, and other documents that we are aware of. Then the other information that the auditor is going to need will be confirmation from third parties. So sometimes you can confirm from third parties, such as the banks. We can write a confirmation letter, or we can write a debtor's confirmation, or we can sometimes even ask suppliers. We can confirm from suppliers. So what's the key principle in audit evidence? On simple terms, what's the objective of the auditor in arriving at audit evidence? So the objective of the auditor here will be to design and perform audit procedures that are appropriate in the circumstances for the purpose of obtaining sufficient appropriate audit evidence. Here we should spend some time. Now they're saying to design and perform audit procedures that are appropriate in the circumstances. I think this one should be underlined. So control. Okay, appropriate in the circumstance, we mean we should be getting evidence at the required level. For example, we want to audit a fleet of motor vehicles which have just been acquired. Then you cannot say the best audit evidence is to ask the watchman. Then that is wrong. And so what we mean is that when I try to gather evidence, you should get the right evidence which is related to that circumstances. And at the end, we should be able to obtain sufficient appropriate evidence. Sufficient means quantity. We should get enough evidence. While appropriateness means quality. So the evidence that we get should be of good quality. So here, I'll emphasize this point when we now have knowledge of audit evidence later on. I'll come back to this point. Now, if you look at audit, it's the same. Even those who study diploma, the knowledge can be the same. Even if you study a degree, the knowledge is the same. Even at this level, the knowledge is the same. The only difference now is at this level, you are a senior individual. So the answers which you are going to provide at degree level and the answers which you are going to provide at this level are going to be different. So we'll be emphasizing on that. Because at this level, they don't need your memorizing knowledge, but they are going to use this knowledge to apply. Okay, so we define sufficiency. We say sufficiency measures the quantity of audit evidence obtained, whereas appropriateness measures the quality or reliability of audit evidence. So we need to balance the two. So which factors affect the quality or reliability of audit evidence? So the first one could be originality. Auditors, when you're an accountant, you meet auditors. So when auditors come to your office, they'll be looking for original documents. For instance, you just bought a vehicle worth 3 million. Let me see the invoice. You cannot provide the auditor with a photocopied invoice. So you as an auditor will be looking at an original document. Because if you have photocopies, the clients can order them. People can edit documents nowadays. So they will look for original documents. Then external. A good example is the customers. If you want to confirm, you as an auditor, you want to confirm a certain balance, let's say of 20 million from a customer, you should not rely on the management to say, does this customer really owe 20 million? The best thing you can do is you can get evidence from external sources. So you can get evidence directly from the customer. So external evidence is more reliable than internal evidence. Or you can, if you are looking for bank balances, you can ask for directly from the bank. Then, auditor. You as an auditor, you're an audit manager. You are there to audit office equipment. So you are looking for maybe printers. So the best thing you can do as an auditor, you can go direct and inspect the condition of the printers rather than asking someone to do it on your behalf. So if you get evidence directly, it will be more reliable than if somebody provides you evidence. Okay, so these, when we start answering questions, I'm going to demonstrate to you how we're applying this, because at this level, we will not be asked to say what factors affect evidence, but we'll be applying them. Then written. Auditors, you as an auditor should always prefer evidence which has been written. The company has just acquired maybe a container to be used as an office. When you are looking for evidence, you can ask for board minutes. Can I see the board minutes where you are discussing the purchase of this container? But don't say, let me see your records, what you are discussing. That's not reliable because people can change oral representation. So we will be more interested in written rather than oral. Entity. Now, when you are trying to get evidence from the entity directly, the only thing that can make you rely on such evidence is when controls are strong. A good example is in, I want to see the customer's balances in Sage accounts. So the auditor will only rely on the balances of Sage accounts, customers from Sage accounts, only if you have got a strong password in your computer system. If your password is weak, then the auditor will not rely on your evidence. So evidence is more reliable when the systems of the company or the internal controls of the system are operating effectively, or when the internal auditor is providing the best services. Okay, now within the field of auditing, under sufficiency and appropriateness, we need to appreciate data analytics. We'll look at data analytics later on towards when we finish the knowledge of auditing, we'll look at data analytics. So within the context of understanding sufficiency and the appropriateness of audit evidence, we need to ensure that we use data analytics, because data analytics will help us produce reliable and relevant audit evidence that is going to support our audit opinion. For example, if you want to sample, it can be very difficult to sample manually. You can use this data analytics software. Now, when you are using these softwares as an auditor during audit evidence, you should consider the following. One, you should choose a suitable tool for the client. There are several tools which you can use. We'll look at these later on. Maybe cloud computing. Maybe you're using machine learning. So choose the right tool. Secondly, make sure that the tool that you're using covers all relevant financial statement assertions. In simple terms, you should make sure that you look at accuracy, completeness, occurrence, existence. All these assertions should be checked. Furthermore, you should perform additional tests where analytics alone are insufficient. So when you doubt the operating capacity of this analytics, the AI technology, then you can try to use other techniques which are manual. Finally, you're supposed to check the reliability of data from each source, such as accounting systems or email. So don't just focus on one system. For instance, say I'll rely on the Sage accounts. You can also look at Excel. You can also look at manual documents. That's what we're trying to look at. So that's how we should appreciate data analytics in sufficiency and the appropriate audit evidence. Within audit evidence, we need to understand this term, management expert. So who is a management expert? Because there's auditor expert and management expert. People confuse the two. So who is a manager expert? So a manager expert is an individual or an organization that possesses expertise in a field other than auditing or accounting. A good example, you want to audit the cancer equipment to see what is its operating life, how is it efficient. So what you can do, you can call somebody who has good knowledge about cancer equipment. For example, a doctor. So a doctor in this case would be a management expert. And that management expert is the work that is going to provide it. It's going to help assist you as the auditor when you are preparing when you are trying to audit financial statements. It will also assist the entity when they are preparing financial statements. So that's a management expert. Okay, now we have said at the beginning of audit evidence, we said that when the auditor is trying to gather evidence, you should focus on assertions. And assertions are very important, because if you don't know assertions, you struggle to generate an answer in audit evidence questions. Take note, in the exam, there will always be a question which will ask you to gather evidence. There will be a question on audit risk, and there will always be a question also on how you are going to gather audit evidence. So, for you to gather audit evidence, you need to understand the assertions. Before I look at the definition provided in your book on assertions, assertions are just defined as, we can just say assertions are what management say about the financial statements. So what management say about financial statements, because management believes that financial statements are accurate, they are complete, they are produced on time, they are well classified, and they are recorded in the correct period. That's assertions. So based on the book, in your book, they have said financial statement assertions are representations by management which can be explicit or otherwise, that are embodied in the financial statements as used by the auditor to consider the different types of potential misstatements that may occur. That's the definition of the book. It's a one definition, but I just tried to break it. But we can just say the other way. Financial statement assertions are what management are saying about the true picture of the financial statements and how this is going to help the auditor to identify misstatements. For example, the management says financial statements are complete, then as an auditor you need to look for invoices and check if everything has been recorded, for instance. Now, you need to know all these assertions at your level, because you are now an audit manager, or you are an audit, or you are even an engagement partner. So there are about, if you count 1, 2, 3, 4, 5, 6, 7, 8, 9, there are 10 assertions. Easy to remember them. We just say ACCA cover. Okay? ACCA cover, or some people will say ACA cover. You can remember them easily. You need to know all of them. Now, accuracy. What does accuracy mean? Accuracy means everything that you have recorded in the accounts is correct. So management is trying to tell the auditor that everything that we see is correct. So we'll look at these assertions in detail. Let's just mention them for now. We have accuracy, completeness, cutoff, allocation, classification, occurrence, valuation, existence, rights and obligation. Okay, now out of these assertions, there are 4 assertions which I'll mention them. There's valuation, existence, rights and obligation, and completeness. These 4 assertions, they relate to statement of financial position. So if you are auditing, for example, non-current assets, you focus on valuation, existence, rights and obligations, and the completeness. The other assertions, accuracy, cutoff, allocation, classification, these and the occurrence, they mostly focus on the statement of profit or loss. Even though some, like occurrence and the completeness, they can belong to both, but mostly they belong to statement of profit or loss. So we'll start looking at each one in detail.